Good morning and welcome to another session of Curious Investors. I would name today's Risky Business. And before we get into risky business, let's just talk a little bit about the disclaimers that are out there. If you, let me share my screen so you can read these just in case you didn't already know them, but here we go. If you wish to remain unidentified from recording, please remove your name and your face from the screen view. This broadcast is strictly our opinions, and today I would say my opinion since nobody's joining me. Stock investing includes risk, including fluctuation prices and loss of principal. Dividend payments are not guaranteed and may be reduced or eliminated any time by the company. The following information is not a recommendation in relation to any named securities. Any references to specific securities are for illustrative purposes only. Content provided at the event is for general information only and not intended to provide specific advice for recommendations for any individual. I am not recommending an investment to you today. Not at all. Do not count on it. It's not going to happen. All indices, if we mention them, are not managed, and it's impossible to invest in those. These are the thoughts and opinions of those of Gimbel Financial and they do not represent the views of LPL Financial. Any tax references are illustrations only. Seek advice from tax professionals before acting on any ideas discussed that might have tax implications. Securities are offered through LPL Financial. Remember, FINRA and SIPC. Investment advice offered through Gimbel Financial, a registered investment advisor and separate from LPL Financial. There you have it. It's risky out there. It is always risky out there when you're talking about investing, and so don't think that there is a risk-free investment, because there's not. Okay, can we get that going today? Because there are just possibilities and opportunities that you just don't know, not only to make money, but to lose it as well. And I think it's all fun and games until somebody loses money, and then they get their feelings hurt and feel like somebody wronged them. And a lot of times they lose money out of ignorance. Now, I'm not saying you guys, you are not ignorant, but those people that lose money are. What do you say we talk about some current events before we jump into the ideas of risky business today? There's always been manipulation in the stock market. And if somebody tries to tell you that it doesn't happen, they're just not being honest. It's always been the case. It always will be the case. It's because human beings are flawed. And if you don't have flawed human beings, then you can get rid of the manipulation of the markets. But humans are flawed. Regulators are generally less gifted than the people who are manipulating the markets. If the regulators were really good at what they did, they would not be regulators. They would be doing things in the markets themselves. And so the people who are manipulating the markets are generally smarter than the regulators, so they're going to maneuver and skate around the regulatory ideas. So what happens then is these criminals that are manipulating the markets, not always criminals, sometimes you can manipulate them within the guidelines, but the people that are manipulating the markets will do something to attract enough attention to get enough people into the particular investments that they're trying to do, and then the thing will implode. And once it implodes, everybody will scream foul. Government has to look good, so the government will then incorporate more regulations, for which they'll hire more regulators to regulate the so-called crime that occurred. But this has been going on forever. This is not new, and it is caveat emptor, buyer beware. Let the buyer beware. You need to beware that the world is not a safe place, and you need to use your own wisdom and common sense to navigate your way through life. So if you're thinking somebody's going to watch out for you out there, particularly when you get in the investment markets, you are wrong. You're going to get your feelings hurt. You're going to blame somebody, but you need to look in the mirror before you start doing anything. Okay, how's that for a disclaimer? Sorry to sound like my dad lecturing to you all. Hey, let's talk about this. There are these guys that were wanting to make a bunch of money, and so they thought that they could do what's called short selling. Short selling is you have the stock. We're going to use stocks as the example. They have this stock that they want to go down in value, and for some reason you can sell a stock that you don't own and then buy it back later. Okay, That's what short selling is. You think a stock trading at $100 a share might go down to 50, and so you short sell it. And when you short sell it, then you begin to make money when it goes down rather than when it goes up. You lose money every time it goes up after you short sold a stock. So there was these people, they decided they wanted to do that, and they saw an opportunity. Maybe they thought the stock was going to go to zero, so they sold it and it began to go down. And then there were these other people that thought it was going to go up. And these two began to clash, and they began to clash in an aggressive way. Their clash caused the stock price to go up and down and up and down and up and down. And they both thought they were right. That's the beauty of the stock market. It is an argument on both sides of a trade. There's a buyer and a seller. They always think they're right when they collide with one another. The buyer collides with the seller, and that's where you have the market price where they collide. Well, when you get short sellers involved with it, these tend to be very aggressive individuals. They tend to be people with just limited guidelines around them. Like they can say things about stocks that they're not regulated with, for which I can't say. And so they're making bold public proclamations to cause the stock to go down. You got that? So there's going to be news out there when these people are short selling that makes the stock probably look worse than it is, because they want to hype up the selling. They don't even want to sell their stock. They want you to jump in and sell with them, which causes that stock price to drop down more and more. And this is all very manipulative. It's all very aggressive. It's risky business, and it causes the stock price to jump up and down a lot with a lot of volatility, which is okay if you like volatility. We are going to try to work our way to entering positions in the investment markets with limited volatility. So when there's a very volatile situation, we're going to generally try to stay out of that and let somebody else have that situation. But anyway, these two groups of people came at each other with a violent approach, and they were so aggressive that the stock price began to just go crazy and crazy. The person who was going short, the leader of the group was going short, ended up being wrong and lost big money. I think we calculated yesterday that short seller lost $20 million, something of that magnitude. $20 million in 2021 dollars. And after this person short sold, he got angry, frustrated, and had revenge on his mind. He was going to come after the person who caused the stock price to go up, but like with an angry attitude. So there's more going on below the water level with short selling, or even the market sometimes, than you'll ever know. And he went and corralled more people to help him with his goal to go after this person who caused his bet on the market to go wrong. And when he did that, he created more hoopla in a different stock, or I think it was the same stock, and the stock sucked in a lot of investors because of all the action, all the news, all the hype. They got sucked into it, and you know what happened? Many investors lost a lot of money because these two parties were going at each other. Many investors lost a lot of money. Some of them, I'm sure, made money, as they might have. There's no Kenny Rogers song, The Gambler. You got to know when to hold them, when to fold them, when to walk away, and when to run. So some of them probably in all that volatility made money. But what happens with all that noise, it creates the sensation that I can make money really, really quickly. And it creates this greed inside of people that they get sucked in and become basically a variation of Wall Street rather than investors, which is okay. Everybody has to kind of operate their own body and do their own thing. However, it doesn't create contentment, fulfillment, and enjoyment in life. And so when this thing happened and it imploded and all these people lost their money, the battle continued on. But the guy that originally set up the scam to try to ruin the other guy, he had brought in these two wealthy investors to help him get it done. And they knew that he was going short the stock, and they turned on him, betrayed him, and ran the stock up themselves and cost him all his money. And so all of that was driven by greed. All of that would sound very similar to the things that have been going on with the hedge fund traders, the Reddit, and the Robinhood investors here these past few days. And this story I'm talking about to you happened in the 1864 Erie Railroad stock manipulation. It was referred to often in history as the Erie War. And the players in this were Cornelius Vanderbilt. He was the one that was being attacked initially, and you've heard of Vanderbilt University. And then we had the great Jay Gould, James Fisk, and Drew. I can't think of his first name right now. But this all happened in the 1860s. Did you know that? Did you know that what was going on with the modern day stocks today that you see in the news, you see on Twitter, you see in all the social media things is not new. It's been going on since probably before the 1860s. There's probably going to be regulation because somebody got their feelings hurt, somebody's going to lose money on this thing. But if you're going to be an investor, these sort of situations are not the prime place to make money and keep money. I'm sure I saw some of the ideas that this guy bought all these options and now he's worth 50 or 100, $200 million. But somebody won the lottery recently too. These things don't happen all the time to everybody, and they create enough energy, greed, and things to make people go out and buy lottery tickets, right? I don't buy lottery tickets because I know the math behind it. I didn't trade in these stocks these last week because greed is a difficult thing to stop, and it causes problems. And so I would encourage you to learn systems to invest, ways to protect yourself, and not get sucked into old habits, old cycles that have to go on with things that probably most of us wouldn't understand. So that's my view of the activities of this past week. And if you made money on those stocks, pat yourself on the back. It's kind of like walking into a casino. If you made money, just prepare to give it back the next time. So that said, let me talk to you about risky business. I put together a list of what I think are risky investment ideas or strategies. And I'll bring this right over here. And let's just talk about risky things real quickly. I know I've taken a little bit of time already, but I'll just walk you down through these and help you appreciate what risky things are. If you're a curious investor, if you're new to investing, these are the things you should step back from initially until you feel comfortable with understanding the risk inherent, the methodologies behind them, and they really aren't necessary in making wealth. I think with the wealth I've been entrusted with, I can say I haven't accumulated any. I don't even think 1% of my wealth has been accumulated with any of these things. I've tried a number of these things, and the money I lose on these strategies, I put in what I call a tuition to the University of Wall Street, or you can call it tuition to the School of Hard Knocks, whatever you want to do. But I just thought I would talk about these since they made the news this week. Short selling, I mentioned earlier, is the idea of selling a stock they don't own and buying it back at a lower price. Okay, so if we say you sell a stock at 100, the most you can make on that transaction is if that stock goes to 0. So you can make $100 per share on that stock. But if you're wrong and that stock goes up, and that stock goes up a lot, you can lose an infinite amount of money. That's the theoretical amount. You probably aren't going to lose an infinite amount of money because there's gauges and guides and governors inside the marketplace that's going to make you pay to play, and you're going to run out of money before you run out of time usually if you're wrong. So that's short selling. Mathematically, it's a bad idea because the market tends to go up over time. There's no guarantees that past performance is going to do the future, but if you have a a trend that works its way up and you betting that that trend is going to go down, you've already started with a disadvantage to what the trend tells you. So short selling, this goes on, hedge funds, seasoned investors do it. Nobody I know has made significant amounts of money short selling. It's a way that some people do it. I just don't know those people. So that's short selling. Options are stock options. We'll talk about those. Stock options are a way to spend a small amount of money and to acquire shares of stock or to sell shares of stocks. These options have time limits on them. They stretch out anywhere from this week to many months from now, and they are a depleting asset that when that time frame expires, they go to zero. So time is working against you in stock options. There's some valid ways to use stock option to minimize risk. There's ways you can just take infinite risk with stock options. And so stock options, I just say, are risky business if you don't know what you're doing. All of these things can have the risk taken out of them by training and education, probably not necessarily from universities so much to say, but people who have traded in these before can probably teach you how these things really work. Maybe I take that back. I don't know if you can make money in penny stocks. It's a whole different animal, but we can talk about that. Let's talk about that when we get down there. Commodities and futures are very similar to stock options. They generally are referred to hard assets like gold, silver, grains, all kinds of things are stock options and futures, where you're putting a small amount of money down to try to get control over a lot of assets. But they have a time frame associated with them, and if you're wrong, that time frame will bite you. Leverage, that's a fancy word for saying borrowed money. Anytime you borrow money to buy something, you've added risk to your situation. And if you borrow money to buy stocks, what happens is if you're wrong on the stocks that you bought, it accelerates the amount of time it takes for that money to disappear and go away. So leverage is not something that beginning investors should add to their portfolio. Particularly, we've been in a pretty long bull market here, probably since April of last year, that things really haven't been difficult. We're starting to see some difficulty. When the markets get hyped up, when you see things like what's going on this last week or so in the Twitter world, you're going to have an indicator that the markets are a little riskier and you probably shouldn't be pouring as much money in right now. Penny stocks, those are stocks that actually could cost pennies. They could cost 50 cents. They could cost $1. They could be up to $5 or $10. There's a lot of variables associated with those low price stocks that if you're going to invest in them, talk to somebody who knows about them before you do it. Talk to somebody who understands the pros and cons and can help you make those decisions. A lot of times it seems as a beginning investor that you'd rather buy a $5 stock than a $500 stock, because if I only had $500, I can only get one share of the $500 stock, whereas I could get 100 of the $5 stock. Well, low price stocks are low price for a reason, and generally the market is going to be smarter than I am as a beginning investor, and so a high price stock is high price for a reason. And again, the market is smarter than me. So if a stock is trading at $500 versus $5, there's probably good reasons why both of them are priced where they are. I'm not saying don't do it. I'm just saying do it with more experience and more training. Initial public offerings, that's often called IPOs. An IPO is when a company is taken into the marketplace and begins to trade on the public markets. And it's the first time that stock's ever traded. Why those are risky business is, let's suppose that I have Keith's Pinball Machine Company, and all of a sudden everybody wants pinball machines, and my business is going gangbusters. I can't make pinball machines any faster than I have. I need to go public with it so I get some more capital to build more factories. And as I build those more factories, all of a sudden I'm selling even more and more pinball machines. And I've worked my fingers to the bone. I'm stressed out. I'm doing everything I can, and I realize I can't really do this forever. I can only do this for a short period of time. I better get some money out of this successful business now in anticipation that maybe it will keep going this direction, but it could go awry, it could go down. And it's got too big that I could just sell it to a guy down the street or something. I need more money than what's available just on ordinary buyers like Joe down the street. So I go to the public markets and I work with an organization that will take a company public and sell shares of it to the world. When I hire this company, I go to them and I say, hey, my pinball machine, and I'm interviewing various companies, my pinball machine company is very, very valuable to me. I want as much money as I can get out of this. And the company A that's going to help me take it public will say, we can get you this much for, say I sell 49% of my company. We'll get you this much for 49% of the company when we take it public. Company B says, we'll get you 1.5 times more than that. And so they begin to compete against each other. This is very, I'm making this very simplistic, but this is the idea. They begin to compete with each other, trying to get me to sell my 49% through them because they're going to make a commission off of that or some fee off of that. Well, it's to their advantage serving me to get that stock price as high as possible. There's a lot of hype. There's a lot of, energy around the name of that stock. And so the more they can get the curiosity and interest about that in the marketplace, the more that stock price is going to go for originally when it starts trading on that initial public offering. Their whole goal is to get that price right out of the gates as high as possible so that it gets me as much money as they promised. And if they can keep the hype there, maybe they can sell more of it later, because I'll still maybe have 51%. And if they sold it at $100 a share initially and all of a sudden the market freaks out and wants to sell it at 200, then maybe I'll sell more at 200. And so that's how the hype behind an IPO works. And so if you're wanting to own an IPO, a lot of times they shoot up the first few days, and then all of a sudden the original investors see that they start dropping off the price and they start selling, and consequently the market begins to sell that stock, and a lot of those initial public offerings begin to drop down after the first few days before they stabilize. So be very, very careful if you're tempted to get into initial public offerings. There is risk associated with those. Emerging markets, those are markets outside of the United States. It might be Latin America, might be Russia, might be Canada. There might be, I don't know if Canada's considered emerging market, might be China, Asian countries. These places that have different forms of capitalism, different forms of legal system, different forms of integrity. There's all kinds of things that goes into the marketplace in those emerging markets and can cause you to lose money. There was a coffee company out of China a year or two ago that they were exaggerating their books, and all of a sudden the stock dropped from 50 almost all the way down to 1 or 2, I forget. But it was because they didn't have the same levels of integrity that's expected inside the United States. So when you're investing in emerging markets, be careful. Those things haven't run crazy like they did many years ago, but if they do start to get some energy and start to run, it's going to seem like easy money, but again, you can lose money really quickly. And then finally, the risky business is to not have a downside strategy. If you're investing, suppose you bought one of those stocks and went wild over the last few weeks, there is a benefit to not getting greedy and saying, okay, I bought this, I'm going to stop the bleeding if it starts selling off at a price somewhere predetermined and not let my emotions dictate how that's going to look. So having a strategy to stop your downside risk of your investments, I think, is one of the best things you can do to eliminate risk from your portfolio, from your investments. And that needs to be predetermined. If you wait until the markets tell you when to sell, you're going to make probably more of an emotional decision rather than a wise financial decision. So there you have it. It is risky out there. It is appealing out there. It's curious out there. I got in the investment business because I found it fascinating. I find it fascinating today. I think it's awesome today. The more that things are manipulated, it attracts people, it gets people in there. People are going to lose money. That's just life. People are greedy and they're going to lose money. Well, that's just, you can't regulate. You can't fix greed. It is what it is. What your goal is to put a system in place, avoid greedy decisions, make decisions that include wisdom and common sense, and don't get sucked into the hype. The hype is where you're going to lose your money. And you don't want to lose money that you worked hard for. If you lucked across these things last week, step back. Don't get back into those things. The reason is, go to Las Vegas, walk around Las Vegas, walk around Atlantic City. Do you think the casinos made money because they lost to you? The idea is, if you go into the casino and you get lucky once, you're going to enjoy it. That was a good experience, and you're going to keep going back to the casino. Eventually, you're going to help build the next building. And with Wall Street, it is not a safe place. It is dangerous out there. All stocks are speculative, and if you don't go into it with a very cautious approach, a strategy that makes sense to reduce your risk, you are going to get sucked into a habit pattern that's going to cost you money. That's all I got on this week. I appreciate your attention. I appreciate your curiosity. Have a great rest of the weekend, and I hope to see you guys real soon again. Take care.